Have you ever wondered what dividends are and how they can benefit you? Well, allow me to shed some light on the subject. Dividends are a portion of a company's earnings that are distributed to its shareholders. Picture it like this. You own a piece of a pie, which represents a company. When that pie grows larger, thanks to the company's success, you get a bigger slice. That extra bit of pie you receive? That's your dividend. Not every company offers dividends though. Some prefer to reinvest all their profits back into the business, hoping to make the entire pie bigger in the future. This can be for various reasons. Maybe they're a young business with a lot of growth potential, or perhaps they're in a highly competitive industry where every bit of funding counts. Now that you have a basic understanding of what dividends are, let's delve deeper into how they work. So how do dividends work exactly? Well, let's break it down. Dividends are essentially a portion of a company's earnings that are paid out to shareholders. This process typically follows a certain timeline that involves 3 key dates: the declaration date, the ex-dividend date, and the payment date. The declaration date is when a company's board of directors announces the decision to pay a dividend. They'll state how much the dividend will be and when it will be paid. This is basically the company's way of saying, "Hey, we've had a good period and we want to share the spoils with our shareholders." Next up is the ex-dividend date. This is the cutoff point for investors to be eligible to receive the upcoming dividend. If you buy shares on or after this date, you won't receive the dividend. It's like trying to get a piece of cake after the party has ended. The ex-dividend date is usually set 2 business days before the record date, which is simply the date when the company checks its records to determine who its shareholders are. Finally, there's the payment date. This is the day the dividends actually land in the shareholders' accounts. It's like payday, but for your investments. But how are dividends calculated, you ask? Well, the amount a shareholder receives is determined by the number of shares they own and the dividend rate. For instance, if a company declares a dividend of $2 per share and you own 100 shares, you'll receive $200. Sometimes companies offer dividends in the form of additional shares instead of cash. This is known as a stock dividend, and it increases the number of shares you own, which can lead to larger dividends in the future. And there you have it. That's the basic process of how dividends work. It's not as complicated as it may seem, right? But why do companies choose to pay dividends? Why do some companies choose to share their profits with shareholders? Well, there are a few reasons companies might opt to distribute dividends. Firstly, dividends can be a powerful tool to attract investors. Regular payouts signal stability and can be especially appealing to those seeking a consistent income stream. Secondly, dividends serve as a tangible indicator of a company's financial health. When a company consistently pays dividends, it's generally a sign that they have a steady cash flow and are confident in their future earnings. Thirdly, dividends can also be used as a strategic move to distribute excess profits. Instead of reinvesting all profits back into the business, a company might decide to share a portion with their shareholders. Lastly, dividends can help maintain investor confidence during volatile market conditions. But dividends aren't just beneficial for the companies, they can also be a great asset for investors. Let's find out how. What's in it for you as an investor when a company pays dividends? You might be wondering. Well, dividends provide several benefits that can make an investment more attractive and potentially less risky. Let's delve into this. Firstly, dividends provide a steady stream of income. This is especially appealing to investors who are looking for a reliable return on their investment. The beauty of dividends is that they're paid out regularly, typically quarterly, semi-annually, or annually. This means that you can look forward to a consistent payout, which can be particularly beneficial for those in retirement or those looking for regular income. Secondly, dividends can help to reduce investment risk. How so, you ask? Well, when a company pays dividends, it's a sign that the company is financially healthy and profitable. This can provide a safety net of sorts for investors, as it suggests that the company is less likely to go under. In other words, dividends act as a buffer, providing some level of protection against the volatility of the stock market. Thirdly, dividends can also contribute to the total return of an investment. This is because the dividends you receive can be reinvested to purchase more shares of the company. This is known as dividend reinvestment, and it's a powerful way to leverage the power of compounding, allowing your investment to grow exponentially over time. Lastly, dividends can provide a measure of inflation protection. Dividends are generally paid out from a company's profits, and as a company's earnings grow, so too can the dividends it pays out. This means that over time the income you receive from dividends can increase, helping to offset the effects of inflation. Sounds great, doesn't it? But as with everything, there are also some drawbacks to dividends. We'll explore these potential downsides in the next scene, so stay tuned. What could possibly be the downside to receiving a share of a company's profits? You might be asking yourself this very question. Well, believe it or not, there are indeed some potential drawbacks to dividends. First, let's talk about capital gains. When a company makes a profit, it can choose to do one of two things. It can distribute part of that profit to its shareholders in the form of dividends, or it can reinvest it back into the business. Now, if a company decides to reinvest, it can potentially lead to an increase in the company's stock price over time. This could mean higher capital gains for you, the investor, when you decide to sell your shares. On the other hand, if a company pays out dividends, it might not have as much money to reinvest, which could potentially lead to slower stock price growth. Next, let's talk about taxes. Dividends can be subject to double taxation. Here's how it works. The company pays corporate taxes on its profits, and then, when those profits are distributed as dividends, you as an investor pay taxes on them again. On the other hand, if you were to sell your shares and make a capital gain, you'd only be taxed once on that gain. Additionally, not all dividends are created equal. Some companies may pay high dividends to attract investors when their business is not doing well. It's a bit like a shiny lure to a fish. But remember, a high dividend yield today does not guarantee a high yield tomorrow. If the company's profits fall, so too might your dividends. And finally, let's not overlook the fact that dividends can create a false sense of security. They can make a company appear more stable and profitable than it actually is, which can be risky for uninformed investors. While dividends can provide a steady income, they are not without their downsides. It's important to weigh the pros and cons before making any investment decisions. So, should dividends be a part of your investment strategy? A thought-provoking question indeed. To answer it, let's take a quick walk down memory lane. We've learned that dividends are a portion of a company's earnings distributed to shareholders, a tangible reward for the trust invested in the company. They work as an income stream, often paid out quarterly, semi-annually, or annually, offering a steady flow of cash to investors. Companies, particularly those stable and mature ones, pay dividends for various reasons. They might want to share their profits with shareholders, attract more investors, or exhibit financial health. For investors, dividends offer benefits such as a regular income and potential for reinvestment. They also provide a safety net during market downturns, as dividends can offer a return even when stock prices fall. But like all good things, dividends also come with a catch. They aren't always a guarantee and can be cut or eliminated if a company falls on hard times. They may also indicate a lack of growth opportunities for the company, as it prefers to distribute profits rather than reinvest in the business. Now, circling back to our initial question, dividends can indeed be a valuable part of an investment strategy. But remember, they may not be suitable for everyone. If you're a growth-focused investor, you might prefer companies that reinvest profits back into the business. On the other hand, if you're looking for a steady income, especially during retirement, dividend-paying stocks could be your cup of tea. In essence, it's all about balance. A diversified portfolio with a mix of growth stocks and dividend-paying stocks could potentially offer the best of both worlds, providing both capital appreciation and income. In the end, whether or not to invest in dividend-paying companies is a decision that should be based on your personal financial goals and risk tolerance. Remember, informed decisions are the best decisions.